Lending to someone with iffy credit would normally be a risky bet. Credit acceptance shifts much of that risk, ultimately onto the buyer, who, having overpaid, is that much more on the hook.
They're setting themselves up for success, even though they might be setting the consumer up for failure.
In fact, the consumer's ability to pay isn't even how credit acceptance decides whether to give a loan.
CAC's business model was actually indifferent to whether borrowers paid their loan back or not. They profited when the borrower defaulted, just the same as when the borrower paid off their car.
After reviewing the company's internal documents, the CFPB found that credit acceptance uses an algorithm to project how much money it will make from the customers over the lifetime of their loan, including from collection efforts, repossessions, and penalties. The company predicted nearly 40% of the loans it made would fail in traditional terms, but still made those loans.
They're calculating a score for the consumer, and it's based on the likelihood that the payments the consumer makes, the value of the car if it gets repossessed, the late fees they charge, the repossession charges they charge, the collection efforts after the consumer has their car repossessed, that all of those are going to equal or exceed this amount that they're paying the dealer.